welcome back. Merle Denbath here. The stock market finished another strong week with all three averages up over 20% for the year for the last 12 months. The S&P hit another high for the year, 52-week high for the S&P. And so everything is happy on Wall Street, apparently. Reports by companies were very strong. Over 80% reported revenue or profits above expectations. In some cases, both profits and revenue were above expectations. The attention continues to be on AI investments, multi-billion-dollar projects in data centers and so forth. That continues to be one of the recurring themes. And of course, there's continuing speculation about what the Federal Reserve is going to do at their next meeting in September. And of course, now there's also focus on what's going to be said at the Jackson Hole, Wyoming annual retreat. Are they going to raise rates? Are they going to lower rates? And there's a lot of opinion and speculation about what the outcome of these events will be, and the popular media is full of commentary on that. But I'm concerned about what's really happening to the millions of Americans who get up daily and go to work and earn and spend and invest and try to cope with the cost of living. What is the long-term trend really showing us here in terms of the overall economy? What about the national debt? What about the service on that debt? What about interest rates? We need to look at a longer perspective than just the next CPI report or the next unemployment data report. So we're going to do that today. We're going to go back and look at what's happened over the last 2 or 3 years and get some type of a longer term perspective of the direction of our economy. Let's get going. Well, we saw the reports that just recently the national debt exceeded $40 trillion, an amount that's almost impossible to imagine. If you would have told me a few years ago that with a Republican in the White House and in control of both houses of Congress, we would have seen the national debt go from $35 to $40 trillion in a 2-year period of time, I would have not believed you. But here we are. And the discouraging thing is there doesn't seem to be any real serious attempt to control the spending. Not surprising, these deficits have been financed largely by increasing the money supply, which of course produces inflation. As we can see here, the mid-year money supply, M2 money supply, has increased from a little over 21 trillion to over 23 trillion recently. The M2 is the broad measure of money supply. It includes not only paper money in circulation, but also checkbook money and various kinds of savings accounts. GDP, or gross domestic product, is the dollar value of all goods and services newly produced in a given period of time, usually a year. And we are looking now at the GDP figures for 24, 25, 26. Not surprising, with all of the stimulus, the gross domestic product has been increasing and now tops $32 trillion. We're looking at data for the second quarter of the 3 years shown. According to the current issue of Barron's, which is dated August the 17th, the share of gross domestic product going to labor is the lowest it's been since 1947, 52.9%. Well, the national debt being financed by bank purchases of U.S. Treasury securities, it's not surprising to see the share of their balance sheet going for treasuries increasing from a little over 15% 10 years ago to over 33% now. And since they're buying more treasuries, they're making fewer mortgage loans. This in turn makes mortgages harder to get and more expensive. With the demand for borrowed money increasing by the U.S. government as well as other governments and businesses, and with fewer mortgage loans being allocated by banks, it's not surprising that interest rates have been going up in tandem with an increase in the 10-year bond, which influences greatly mortgage rates. As we can see, in the last 3 years, there's been a steady climb in the cost of a 30-year fixed-rate mortgage. The expansion of the federal debt and the accompanying increase in the money supply and inflation has not been kind, really, to workers. From July of 2023 to July of 2026, both unemployment and consumer price index or inflation rates have increased. Well, the economy has grown, the national debt has grown, stock market prices are at all-time highs, but unfortunately, wage growth for workers has not kept pace. It's actually slower now than it was in recent years, according to data from the Federal Reserve. Another measure of lagging wage growth, looking at the hourly earnings between 22 and 23 and 25 and 26, we can see that the growth in earnings declined over that period of time while the CPI increased over that period of time. There are many other examples like this that could be presented. The bottom line is that we've got a booming economy that's moving forward, creating jobs, creating wealth, but unfortunately for a lot of workers, from an income point of view, they're left standing still. Well, that concludes my program today. Thanks for tuning in and subscribing. We'll see you next time.